President Trump bashing Fed Chair Jay Powell again. The president reportedly telling Republicans that the central bank leader has, quote, no feel for the economy. That's according to Politico. President Trump also blasting Powell by comparing him to a bad putter, referencing his favorite sport, golf. Joining us now, Merion Capital Group Chief Market Strategist Richard Farr. Richard, you actually agree with the president that the Fed has no feel. So explain this to me.
Yes, I do actually. Well, first off, I'm sure Donald Trump says that to everyone he golfs with.
Well, they're bad putters.
They're
well,
all
I'd like to see what kind of putter he is.
They all hit the ball in the woods, I'm sure. And I'm sure Jay Powell can handle it. But on that note, we have really struggled with the decision to hike rates in December. In our view, it was pretty clear when the December Fed meeting came that inflation had peaked 3 months prior. We had a lot of weakness in global data and global growth. It was all well documented. The tariffs we didn't know exactly the impact, but we had to figure it was going to be a downward impact on GDP and global growth. And we also had the shutdown issues to contend with. So in our view, it was a perfect opportunity for the Fed to say, let's put our models aside. Let's think a little rational here. And why don't we just wait till January? And so my view is I think we shouldn't be treating Powell as the scapegoat so much because the Fed was unanimous. And we looked back today and we said, well, when was the last time anyone at the Fed dissented on anything? And you have to look back to literally the middle of Yellen's term when Neel Kashkari was dissenting on some of the Fed rate hikes. And that to us is a little concerning. It's almost like the Fed is becoming a little too groupthink, and I somewhat applaud the president's decision to try and mix up the apple cart a little bit.
Okay, so what I'm hearing you say basically is that you don't necessarily disagree with this patience, but they should have been patient sooner.
Right.
They shouldn't have caused that volatility that we saw in the fourth quarter. I guess, the president coming out and saying this now when the Fed is sort of towing the line and saying we are watching things more closely. I mean, is there any point?
I think it's electioneering, personally. I think, we've got some weakness in the stock market now. We've got some weakness in the economy. Q1 GDP is looking like it's going to be, pretty weak, less than 1%. Year-over-year earnings looking like they could be negative or flat on a year-over-year basis. So I think Trump is getting out ahead of it as we head into the election cycle and saying, hey, maybe this is all Powell's fault. And so it's a little bit of gaming there.
Do you agree with a lot of the view out there and basically what Powell has told us at the press conferences so far this year, that there won't be any other hikes this year?
I think that is the case. I worry about the Fed. They're so wrapped up now in their dot plots and their forecasting that it handcuffs them. If you look at the history of the Federal Reserve, their ability to forecast is pretty bad. They don't catch any of the inflection points. So our argument is, why even start to move the market in that direction when you don't know? Actually, if you look at some of the inflation data, shelter costs are starting to rise in CPI. And at the same time, oil prices are starting to break out higher again. So you can have a case come September or October where inflation is running hotter than people thought. And the Fed should just sit back and not state any view at this point. Just say, hey, we're going to sit back and watch.
We're watching and waiting. Well, it's interesting because despite the Federal Reserve's dovish outlook, Morgan Stanley is actually cautioning investors that a negative earnings growth impact can weigh on the markets. According to FactSet data, the first quarter's S&P 500 earnings expected to decline 3.7%. First quarter is seasonally weak. Do you agree with that sentiment?
Yeah, it's actually a little worse than we had been predicting. We were saying earnings would be roughly flat on a year-over-year basis. Usually we're below the street, so I'm kind of surprised to see the street move this much so quickly. You have a lot of things going against earnings right now in the first quarter, everything from the shutdown to global growth. One of the arguments that we have been making is that 43.6% of S&P revenues are outside the United States. So it's easy for us to look at the U.S. data and say, hey, U.S. data is good, therefore you should buy stocks here, but not when 43.6% of the decision has nothing to do with what you're seeing in the U.S. So one of the arguments that we've been making this year is to shift more domestically and look more at Russell 1000 value and things like that and reduce some of your international exposure.
What I think is particularly interesting is that you use the energy sector, which is a sector that I cover closely, as a basis for determining S&P earnings.
Well, it's a huge delta. And that's one of the things that we have been concerned about is if you look at What we like to do is deconstruct S&P earnings estimates. We have to look at the actual dollars that people are forecasting. So if you look at the tens of billions of dollars that are being baked into S&P earnings for the energy sector as we get into the second half of this year, we haven't seen those kind of numbers since oil was $70 to $80 a barrel. So you're baking in quite a lot of upside. There must be an awful lot of efficiency happening in the energy sector to bake in 10, 15, 20% rise in oil prices from here. So in our view, there's downside risk simply from that alone, let alone an inverted yield curve, which may start to hurt the banks, let alone the global growth, et cetera. That's going to start hurting things.
That's what's causing the volatility as of late, at least of the last few days. Your thoughts on whether that inversion is going to remain and if it's as big of a problem or a red flag as some investors feel it could be?
So 7, 8, 10, 11 basis points, it's really irrelevant.
Right.
The issue to us was, and it gets back to this Fed conversation that we just had, rates are falling around the world. We have $10 trillion of negative yielding debt globally right now. And 25 basis points may not sound like much, but when the global comparisons are negative yields or near negative yields, it matters. So, a 25 basis point hike in December may have kicked off the yield curve inversion now.
Yeah, something to watch closely. Richard, great to see you. Thanks so much.
Thanks for having me.